For small business owners, choosing the right tax structure can make a significant difference in how much money you keep. Many entrepreneurs wonder if electing S-Corp status is the right move for reducing their tax burden. While this option isn't for everyone, it can provide meaningful tax savings when used correctly. Let's break down how S-Corp work and whether they might be right for your business. What is an S-Corp? An S-Corporation, or S-Corp, isn't a separate type of business entity. It's a tax election available to qualifying corporations and LLCs. By filing IRS Form 2553, eligible businesses can choose to be taxed as an S-Corp. The biggest benefit: pass-through taxation. This means the company itself doesn't pay federal corporate income tax. Instead, profits or losses flow directly to shareholders and are reported on their individual tax returns. Potential tax savings with an S-Corp: avoiding double taxation. Unlike C-Corp, which are taxed at both the corporate and shareholder level, S-Corp avoid double taxation by passing income directly to owners. So, let's talk about reduced self-employment taxes. LLC members and sole proprietors, they usually pay self-employment tax, which covers Social Security and Medicare, on their entire net earnings. But with an S-Corp, owners can actually pay themselves a reasonable salary, which is subject to payroll taxes, and then take the remaining profits as distributions. Those distributions aren't subject to self-employment tax. This setup can really result in substantial savings. For example, let's say an LLC owner earns $120,000. They pay self-employment tax on that full amount. But if you're an S-Corp owner, you could pay yourself a $70,000 salary and take $50,000 as a distribution. Only the salary portion is subject to payroll taxes, which can make a big difference. There are some other advantages of S-Corp status too. It can be easier to raise credibility with banks, investors, or clients. Plus, you get the ability to split your income between salary and distributions, which is great for tax planning. And, depending on where you live, there might even be some potential state tax savings. So, there are a few things to consider before electing S-Corp status. While S-Corp status can definitely be attractive, it's not really the right fit for everyone. Now, about the reasonable salary requirement. The IRS actually requires owners to pay themselves a fair salary before taking any distributions. If you try to lowball this, it can trigger audits and, honestly, some pretty steep penalties. When it comes to eligibility rules, not all businesses qualify. You must have 100 or fewer shareholders, and all of them need to be US citizens or residents. Also, certain types of corporations just can't elect S-Corp status. So, S-Corp need to run payroll, file extra forms, and keep up with all those corporate formalities. And honestly, that can bump up your accounting and compliance costs quite a bit. So, when does it actually make sense to elect S-Corp status? Well, it often makes sense if your business is consistently profitable. You earn more than you would reasonably pay yourself as a salary, and you're comfortable dealing with some additional reporting requirements. If your business is still in its early stages or it's generating only modest income, honestly, the savings might not really outweigh the extra costs involved. Here are a few final thoughts. Electing S-Corp status can, be a powerful way to reduce self-employment taxes and keep more of your business profits. But the decision really should be based on your specific income level, your goals, and your long-term business strategy. At SK Tax Associates, we help small business owners figure out whether S-Corp status is the right move. And we handle the setup process to make sure you stay compliant. If you're thinking about making the switch, now is definitely the time to start planning.